everybody. Welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As we get started, let's do a quick systems check. If you would, type OK in the chat box if you're hearing me clearly and seeing my screen all right. I can see there are more attendees still logging in. If you would, if you're hearing me clearly and seeing my screen all right, go ahead and type OK in the chat box. Okay, great. Looks like we're up and running fine. If anyone has any issues as we go along, feel free to let me know. As always, keep in mind that no one trade is guaranteed to profit. With each trade you take, there's obviously risk involved. And so you want to manage your risk in a way that makes sense for you. And we'll go over some ideas in that regard using some of the tools within our web trader and that are also found in our mobile app, AvaTrade Go. And also keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Now, real quick, for anyone who's brand new to things, what is fundamental analysis? It's a pretty simple concept. It's looking at the news, different types of news, and trying to decide how that might affect the movement of different instruments that you're trading on. And so we could look at news that's kind of scheduled and more regular, like economic calendar type events, which we'll do today. And there was a big one yesterday and a couple large announcements still today, actually a few. We'll kind of weed through some that I think show the best statistical advantages from the past in terms of deciding what to trade. And then obviously there are other types of news that come out that are not scheduled, and we might call those extraordinary events that can have an effect on different parts of the economy, whether it's war breaking out somewhere, a disease spreading or whatever it might be. We've had those things and others occur in the past years that certainly affected the markets in largely in predictable ways that you can try to take advantage of. So we don't so often have these extraordinary headlines, but they do occur. Today we'll be leaning on the economic calendar and the scheduled events because there are a number of them, and we don't have a lot of unexpected headlines happening right now. As we go along, if you have questions, you want to give input, please do so in the chat box. I'm happy to answer questions as they come up and also share information that might be pertinent to what we're talking about. Now, real quick from our main website, you can find our mobile app, which allows you to trade just like our web trader on the MT4 accounts and MT5 accounts from one location. So you don't have to have the MT4 app and the MT5 app or the MT4 platform and the MT5 platform. You can use our web trader and our app to trade on all account types with MT4 and MT5, and also with advanced functionality, some of which we will use today with the special tools, the economic calendar that has the data crunching tools attached to it that we'll use, and the signals and everything else that you find in our platform and app that are not in the MetaTrader platform. So we'll make use of the fundamental news stuff today from our platform. Now, if you go to trading platforms, you'll find AvaTrade Go right here, but you can just go to your app store and download it. There's a link to the Google Play App Store and the Apple App Store right here that'll take you to, depending which device you're using, the proper app store. Okay, so we'll log in here from the upper right and begin on the web trader. So given that it's a fundamental analysis webinar, I think we'll jump right into the economic calendar. There's quite a bit to look at on it, and I think this will be our focus, like I said, today for fundamental news. So first, I want to show an example of what happened yesterday. If any of you were unaware but watching the charts yesterday evening / nighttime and wondered what the heck happened, why did gold spike up, I don't know, $40, $50 an ounce in less than an hour? Why did the euro and the pound climb against the USD and the Australian climb against the USD, etc., so rapidly? This would be the answer as to why. If we look at yesterday's announcements on the economic calendar, we can see out of the US in particular, there was a rate decision. The Fed rate decision came in as expected, so you'd say, well, what's the big deal? The last few times the US has kept the rate steady after having raised it, I don't know, 10 or 11 meetings in a row. They've kept the rate steady. If you don't know the backdrop on why did the US raise interest rates so much, It's related to the fact that inflation was so high in the US and really around the world. Other countries did similar measures with raising interest rates to tighten monetary policy to try and bring down inflation. If you raise interest rates, that strengthens the currency typically and makes it more expensive to get loans, makes the cash on hand smaller, therefore the buying power is less, therefore prices stop rising so fast. So it's kind of the idea of raising interest rates to bring down inflation. Obviously, there's the risk of the other side of the coin, where you could slow things down so much that you move towards a recession. Thankfully, that hasn't been the case yet, at least not in a strong way in most countries, although there has been some economic pain, like they say pain at the pump, where people can barely afford to fill their gas tanks, and charging up credit cards, and money, cash on hand is running low for many people. But it seems people are hanging on enough that we're not getting into a situation where we have a huge stock market crash or anything like that, at least not yet. So right now, the Feds in the US decided, again, not to raise the rate, to keep it steady, that inflation is coming down enough that they anticipate maybe not needing to raise rates anymore to get out of this current inflation crisis that had been occurring. So the difference this time with keeping the rate the same compared to the last couple times that they kept it the same is what they said, not so much what they did. It was expected they'd keep the rate the same, and they did, but what was said was a bit more dovish, as they call it, meaning they came out and rather than talking hawkish is the other term, and saying, the economy is still strong, we may still have to raise interest rates. Instead of saying that, which tends to keep the USD strong, they said the opposite. They came out and didn't raise the rates, and this time talked dovish, saying we may see the need to lower interest rates coming into the next year because inflation is dropping faster than expected. This is what they were saying. And we're talking about with the press conference, which occurred shortly after the rate decision, okay? And the economic projections came out with the rate decision. Okay, so all of that's packaged together to say, wow, the US was pretty dovish with this monetary policy statement and plan moving forward, which really weakened the USD. So, if the US dollar's weakening like crazy, well, it makes sense. Gold could go up easier, the euro can go up easier, and the pound can go up easier, the Australian, etc., against the US dollar. Now, an exception maybe was crude oil. It didn't go up against the US dollar. I think it continued dropping, but if you understand economic slowdown equals less demand for energy, it makes sense that maybe the energy sector didn't go flying up as fast as the other currencies did, or gold against the US dollar. Okay, so all of this, the reason I'm telling you is I want to show you what you could have done if you didn't. Okay, so using this tool, before the announcement came in, you could have clicked on this volatility tool over here and analyzed, well, what happened after the last rate decisions that came in as expected? And again, we can look at how many came in above forecast in the past year or so. None. How many came in below forecast? None. So you could project that, okay, almost all the time, the rate decision comes in as expected, which it did again yesterday. So if in the past it came in matching the forecast, what happened with the currency pairings? So we could have looked and said, wow, 67% of the time, the pound went up against the USD when the rate decision matched the forecast, okay? And here's yesterday's, by the way. Now it's included in the data. But already it was the majority of the time, the USD weakened against the pound if the rate decision came in as expected. And again, look what happened, okay? It happened again. And it happened larger this time because of not just the rate decision coming in as expected, but also what was said. Buoyed this even larger weakening of the USD against the pound compared to the past movements, but all of them were significant, okay? That, 67% of the time anyways. We could look at Euro USD. Okay, 78% of the time, even more consistent movement. And this is the one maybe I would have chosen the trade on, because looking at the past data, it was the highest percentage in terms of being able to try and guess which way will this go if it comes in as expected. Okay, if it came in matching the forecast, which it did, and you see in the past, the vast majority of the time it went up after the rate decision came in as expected, and again, this time it did. Okay, so it would have been an easy way to trade. And you might say, yeah, but you're trading after the rate decision came in, meaning it already moved. And that's really not the case, because we can see after 4 hours, it moved a range of 76 pips, right? If you got your trade off in the first 5 minutes, after these announcements, look, range movement less than half of that, 38 pips or even down. Look how many of them went down in the first 5 minutes, right? And then after 4 hours, almost all of them were up. There's only 1 or 2 you might have lost on a small amount, and you don't have to put your stop very far away, because we see the range movement that occurs typically with this announcement. And if after the first 5 minutes, you get in at any of these entry points down here or these points here, after 4 hours, look how much further they moved. Okay, we're talking range movement 76 pips versus 38 pips. And a lot of this was downward movement, that 38 pips, giving you an even better entry point in that first 5 minutes. So again, this announcement would have been quite easy to trade on. GBP USD, Euro USD, waiting to see the numbers and being able to trade with hindsight, as they say, is 20/20, right? Hindsight has 20/20 vision, meaning you already know. You're not trying to guess that they were going to keep the interest rate the same. You can see it, already know, and then trade on a strategy like this, knowing what the average range movement has been in the past and the directionality percentage. You're not going to win every time, right? 2 of these dropped, but you can manage that risk with a proper stop loss distance and go after quite a potential profit, okay? So that was yesterday's rate decision out of the US, came to fruition as would have been expected based on the past data, okay? Any questions? I'll pause for a moment before we look at today's rate decisions that are coming in, where you get a second and third chance at this strategy. Okay, I don't see any questions popping up, but if I do, I'll address them. I know it takes a while sometimes to get the questions in, and before they come through on my side, there's a little bit of a delay, I think. So, okay, let's look at today's announcements then. Something that didn't already happen. By the way, a lot did already happen, and you could have already analyzed any of these high-level announcements or even the medium-level announcements. The ones that are high-level tend to have larger movements if they're labeled as high importance, but it doesn't mean the medium level announcements aren't tradable. They certainly can create some significant movement. So we had unemployment rate numbers coming out of Australia, all kinds of stuff that already came in that you could have looked at the start of the week, identified with the tool we just used if there's a high percentage probability based on how it comes in. In this case, this one came in higher than expected for unemployment rate. You could have already known what's the typical movement in the hours following it in the past if the unemployment rate came in higher than expected. Maybe it showed 80% certainty or 75% certainty in one direction or another, and you could have traded on that one as well, okay? This is a strategy where you have lots of opportunities to find statistics in advance of the announcements and be ready once they come in to place a trade with directionality, distance, all of that already in mind as to what your trade plan will be, okay, based on how the announcement comes in. But let's look at something that didn't happen yet, okay? If we get past this red line, that means these haven't occurred yet. Interest rate decision out of Great Britain, okay, that's coming soon. So we're not gonna spend too much time in this webinar carrying you past that announcement time because it's in about 45 minutes, okay? I want you to be able to watch that rate decision if you want to and trade on it if the statistics deem in your mind that you should based on how the numbers come in. And again, if we look at the statistics for the rate decision, similar to the US, most of them come in matching the forecast, okay? All of these came in matching the forecast, these 6 events, and when they did, just like the U.S. strengthened, or I'm sorry, the U.S. weakened after the rate decision was as expected. Look what happens with the pound after the rate decision comes in at the expected decision. So if it matches the forecast, the pound drops 2/3 of the time. Just like the U.S. gave up ground to the pound and the euro, with the pound and euro rising against the USD when the rate decision came in as expected. The same here. The pound is weakening if the rate decision comes in as expected 2/3 of the time in the past. Okay? So it's the same setup. It's not an upward movement because the pound is listed first here. When we were looking at pound USD, the USD was listed second. So a weakening of the USD meant the pound went up. In this case, a weakening of the pound means the pound goes down. Okay? So, but it's the same thing. Statistics show if it comes in as expected, 2/3 of the time, the currency for the country for which the rate decision was announced weakens 2/3 of the time here. In this case, the Great Britain announcement and the pound. Okay? Does it mean you'll win every time if you do this? No. But certainly we see a statistical advantage. And yesterday it came to fruition for the US one. Okay? Perhaps it'll happen again here. Again, you can measure your risk because we know after 4 hours, it's over 102 pips range movement. In the first 5 minutes, only 36 pip range movement. And look how many of them went up in the first 5 minutes. Even though after 4 hours, the expectation was most of them would be down. So again, in the first 5 minutes, you didn't miss the movement here. And you could have then put your stop loss from these entry points with slight drop or even a rise with your stop loss a short distance away and then waited to see if after 4 hours it came to fruition and was one of these majority that dropped significantly after the first 5 minutes. Okay, so yes, some of them were dropping within that first 5 minutes too, but a much smaller range movement in that first 5 minutes compared to how far many of them ended up after 4 hours. Okay, so again, this looks like something that could be quite tradable if you were interested in waiting for that announcement, seeing if it comes in, matching the forecast, and going with the large amount of data points here. Okay, do some of them come in above forecast? Yeah, once. Below forecast? Yeah, one time. But that's not a lot of data points to have one time that it came in below forecast or above forecast, and I don't trust it with one data point. Okay, but if it comes in like most of them do, matching the forecast, we've got a lot of data points, multiple anyways, to base our decision on. Okay, I see a question has come in. Okay, so the question is, if the USD is weak, like yesterday, can you buy against, with any currency, I think you mean against the USD, or should there be specific ones? And my answer would be, I would try and have specific ones. Meaning, for example, if with this announcement, I know there's a euro rate decision coming, I'm probably not going to trade euro GBP, because when the euro rate decision comes in less than 4 hours after this one, it could mess up my pound movement. So I probably want to trade on something that maybe is less likely to have another rate decision announcement, another large announcement that could mess up my movement before I can hopefully take profit. So I will be selective on which pairings I think make the most sense for the given announcement. And even better if before this announcement there was weak data or strong data on the USD that would help the movement, then I take that into account too. Okay, very good question. Now, what else do we have? So we see statistical advantage here from the past if the rate decision comes in as expected. And if that's the case, then it looks like in the past the pound is weakened in the hours following that rate decision. Now, if we go down to the euro interest rate decision, which is coming not that long after this one, we can take a look and see something similar. Euro USD, all events, 3/4 of the time, 75% of the time, the euro weakens after the rate decision. And we know most of the rate decisions come in as expected. If we classify it, say if it comes in matching the forecast, okay, it was all of them. They all matched the forecast. 75% of the time, 6 out of 8 events, the euro weakens when the rate decision matches the forecast of what's expected to be done. Okay, so again, large statistical advantage, large range movement, near 100 pips after 4 hours. Within the first 5 minutes, only 24 pip range movement. Okay, half of them went up, half of them went down within only a 24 pip range in the first 5 minutes. So you can catch some nice high entry points, or only down slightly, less than 25 pip movement in the first 5 minutes. And after 4 hours, almost 100 pip range movement. Okay, so on most of these, nice profit potential, and the win percentage looks like in the past you'd have been successful if you traded in the direction that this shows with interest rate decisions when they come in as expected. Okay, so 2 examples of what you could try and do to see if you can replicate what happened yesterday with the US rate decision. Okay, so it's a pretty active day on announcements. We'll likely see large movements in the commodities as well, the major indices. So you could get some great opportunities there also. And so if we're taking a look then later in the day even, now we have some US announcements, okay? And I wouldn't suggest that you have to trade on all of these. If you've made a move on the rate decision, it doesn't mean you can't then trade on the retail sales, but if you're trading here, maybe Euro GBP would make sense, or Euro JPY, so that the US announcements don't mess up the movement on your Euro trade. So you might use Euro JPY here, and when the US announcement comes in, trade Euro USD or GBP USD. Okay, you see how it might make a difference which currency pairings you trade on, with considering the fact there's more announcements to come that could mess up a Euro USD trend. So maybe you check the statistics on Euro JPY for a move, okay? And you'll probably see something very similar, percentage-wise. Okay, so retail sales out of the US, jobless claims out of the US. There's been a large focus on job numbers because it seems to have been the last part of the US economy to slow down. While all the other numbers seem to slow down, inflationary data, etc., they kept saying it's a tight jobs market. And that was the reason why they still weren't going to even consider lowering interest rates back down. Well, lately, that tight jobs market has started to loosen a bit. And that's likely why yesterday the US talked about lowering interest rates potentially in the coming quarters for the first time in a long time. So there probably is going to be a large focus on the initial jobless claims today. And so if we take a look then at what's happened in the past around these announcements, if this comes in above, and by the way, this type of data, unlike the interest rate data, almost always comes in above or below expectation rather than at the expected number. It's hard for it to hit the exact number. Sometimes it does, but you'll see above forecast, 3 out of 4 times, the movement dropped. And if it went up barely. So you can see 1 barely went down, but certainly you weren't losing if you sold. 1 barely went up, very small loss if it indeed hit your stop loss. And the 2 that really moved much larger than the one that went up. So 3/4 of the time it dropped, and when it dropped, on average, it was a much larger movement down in the 4 hours following the announcement, near 51 pip range movement compared to any negative movement if you had been selling here. So 75% of the time it dropped, and 50% of the time it dropped quite large. And the times it didn't drop, it went up very little. So you can start to not only look at percentage of direction, but also distance compared to one direction and another. Okay, proportionality of risk compared to potential profit, which here is huge potential profit compared to the small risk in the other direction when you look at these data points. Again, it doesn't guarantee that's what will happen in the future, but this is data-driven trading. This is what we have to go off of if we're doing data-driven trading. And so if this comes in with higher joblessness than expected, initial jobless claims above forecast, it looks like the USD strengthens with fear. Okay, strengthens with fear. That tends fear on the markets of recession or bad economy. Many times people will rush to safe havens as they sell off maybe stocks, and many times the default currency when stocks are sold, like on Wall Street, they're going right into the USD. And so whatever rationale it is, which I'm trying to come up with one, it really doesn't matter if the statistics come through. The why isn't important, but the what happened is. Okay, we're trading for the movement, not necessarily the rationale when we're using data-driven trading. So we see 3/4 of the time downward movement in the 4 hours following this announcement. Okay, if it comes in higher than expected. In the first 5 minutes, we only see 16 pip, 17 pip range movement, and half of it was up. Look, we're up 14 pips. We're up 10 pips in the first 5 minutes. And then after 4 hours, none of them are that high. Okay? This one is 7 pips. So in fact, if you caught those points in the first 5 minutes where they were here and entered your sell trade based on the statistics we saw, then after 4 hours, all of them would have been in profit, because they all went down further than where they were in the first 5 minutes, even though it says 75% finished down from the exact time the announcement came out. So you can start to use this data to not only think about directionality, but timing of when you want to enter after the numbers come in, and then when you might want to get out in terms of distance movement expected with the average range movement here. And this is based on commonly used average true range movement that analysts and those who look at statistics utilize, the true range movement, okay, of the movement after these last announcements. Okay, so another opportunity here that's not a rate decision, but jobless claims numbers out of the US, they come in higher than expected. It looks like in the past you'd have been mostly successful selling. And what if they come in below forecast? Look at the difference, night and day difference. Now we're talking 86% of the time the euro went up against the USD. What a difference, right? Look at all the green when the data comes in below expectation. Look at all the red when the data comes in above expectation. So there's a clear trend here that gives you the flip movement based on how these numbers come in, okay? And again, we have 45 pip or so movement in 4 hours. In the first 5 minutes, only 8.5 pip movement, with most of them dropping in the first 5 minutes, one of them going up maybe 16 pips. But after 4 hours, we're talking almost all of them are up, and we're talking around 25, 30, I'm looking at each one of these individually, 45, 50 pip range movements here, mostly in the upward direction. One time you'd have lost here after 4 hours, okay? So this data means something, these announcements mean something to the world global markets that are trading on these currency pairings. And again, you can shop the currency pairings. If we look at the pound, we'll probably see a larger range movement. Look, 57 pip range movement, also 86% of the time up. With the Euro USD, it's a slightly smaller range movement, not 57, but 46 pip movement, okay? The pound USD tends to be a bit more volatile than the Euro USD, and that might be something you like as a trader, go after those larger movements, or something you don't like. It's up to you if you want the one that moves a bit more on the chart statistically. All right? Any questions on any of this? I'll pause again for a moment. Okay, great. I must be pretty clear. I don't see anyone dropping out, so it must be interesting. And also, I don't see too many questions popping up, so good. I must be doing a good job of explaining. All right, so what else can we look at fundamentally speaking besides the economic calendar, which obviously is a handful right now? There's a lot going on in the economic calendar today, but you also could look at the market buzz. This gives us news on whatever instrument you want to find news on, and it pulls it from the internet, the most recent news it can find. Maybe you're interested in a certain stock or a certain currency pairing or a certain commodity, etc. You can switch categories. The one that's in the biggest circle has the most mentions and information found online about it. So, you might say, well, what's going on with Amazon? Why is it so much trending so much more than the others? And so I can click on it, find the hundreds of mentions and articles that have been found on it, and you can start to read the individual articles, okay, to find out, well, what's going on, either with Amazon in particular, or at least with the tech sector. Some of these will not necessarily be about the stock or exact instrument, but it'll talk maybe about, in case of Amazon, some of the articles might be what's going on with the tech sector. Is it bullish today? Okay, so you can go through the most recent articles and read them. Okay. Also, you have a technical breakdown. The analysts think the price might go up 11.5%. That's good to know. You can click on it and get the trend analysis. It shows you the support and resistance levels. It shows you where you might take profit. It tells you which indicators are being looked at to help determine the technical analysis. So you've got a plethora of information here, not just fundamental news, but also technical signals and a breakdown of the technical analysis as well, to kind of put together not just one tool, but several tools to create trading strategies. So, I might look and see on the economic calendar that, wow, there's positive momentum. The economic calendar shows that, the USD is weakening and other currencies are going up, which many times means stock market is going up as well. So that might be one thing on your checklist, to see a weakening USD and other currencies going up. And then you have something else on your checklist where you check the market buzz to see a particular stock, to see if there's positive articles about it. And as you get 2 or 3 things that say, okay, now all of that's in alignment fundamentally, now I'll look at the technical signal and see if it's saying I should buy as well. And if everything agrees, then you make your move on Amazon or whatever it might be. Okay, so not only trading on announcements on specific currency pairings, but then also using that information with other information to have a strategy to trade on other things as well that are interconnected, which many instruments are interconnected. Many times when you see indices going up, you also see the USD weakening. You can kind of put those trends together. It's not always the case, but many times it is. Okay, so this is how you build a strategy using different tools to form that strategy. Okay. All right, everybody, I think this is a good place to stop. Good luck with your trading. If you're going to trade on those announcements upcoming today, just try and work on your timing, minimize your risk. Don't get into this necessarily going after a huge trade. Try and keep the exposure amounts to what's acceptable for you, and see what kind of statistical advantage you can take advantage of from this fundamental news. All right, everybody, thank you for joining. Till next time, good luck with your trading.